Hello and welcome. As you read from the title, Berkshire Hathaway is my single largest investment and it constitutes more than 25% of my current six-figure portfolio at the time of this recording. And here are 5 reasons why Berkshire Hathaway is my number 1 investment. Reason number 1, when you invest in Berkshire Hathaway, Warren Buffett is your portfolio manager. In the last 50 years, Warren Buffett has created more than $400 billion in value for its shareholders. He also has one of the most impressive track records of success as a money manager. But what really distinguishes Warren from other money managers is that most money managers in today's markets are looking for hottest issues, new IPOs, more riskier bets where they can place their investors' money to get the biggest gain. On the other hand, Warren Buffett actually tries to reduce the risk and never invest in an IPO. And after listening to modern day CEOs which are more focused on filling their own pockets than actually lining up some profits for the investors, I completely agree with Warren Buffett's idea of not investing in risky businesses and risky ventures. On the other hand, Warren only invests in businesses that are cash flow rich, have a big financial moat behind them, and at the same time, these are not the businesses that can hurt investors in the long run. Number 2, be greedy when others are fearful. Warren Buffett has a very popular line, be greedy when others are fearful, and this is a proof of how Berkshire Hathaway has actually built this enormous amount of $700 billion wealth that it has today. A big part of why Berkshire Hathaway has been such a success is not that they buy right businesses or they buy better businesses, but also that they buy these businesses at very low prices. You see, when we're in a bull market, stock prices keep going high day by day. That makes stocks more and more impressive and people line up to put their money into stock market. As money keeps growing, no stock price looks too high to be paid for a stock. And if a stock keeps going up, the public doesn't really care what the true value is as long as they can sell their stock to somebody else for some more profits. This makes the investing public take excessive risk during the bull markets. However, exact opposite behavior is seen when a little bear market comes. The moment we see a tiny little correction, you will see investors rush in to sell their growth stocks. Something like that is currently happening in the markets right now. But this goes against the logic. When the price of something reduces but the asset stays the same, it becomes a much better investment to be done at a lower price. However, when stocks lose their value, investors mostly completely forget this logic and start rushing in to sell even at losses. Now, the reason why Berkshire Hathaway has been such a big success is that Berkshire Hathaway is built on the strong foundation of paying the true worth of a business. That is, when Berkshire Hathaway invests in a business, they try to find the real worth of a business and only invest at a price suitable for that investment. Hence, it makes large investments when the stock market is depressed. On the other hand, in the last 2 years when the stock market has been on a crazy bull run, Berkshire Hathaway has actually sold more stocks than it actually bought. Number 3, financial stability. When you think of a common investor's behavior, you can see a very clear pattern. Most of us invest based on how our character is as a person rather than the news we actually hear. Some people love to take aggressive risks. They like to buy meme stocks, they like to buy excessive growth stocks, and at the same time they like to take big gambles. On the other hand, some people are very conservative. They prefer to avoid all risk and only invest in cash flow rich businesses. I come from a middle class Indian family and I can't even digest losing a $20 bill. So when it comes down to taking risk, I am the most conservative when it comes down to risking my money on aggressive ventures. Hence, when it comes down to my investments, I seek financial stability over anything else. Even if the business might be a little boring, but it can make enough cash to pay back my investments in the next 5 to 10 years, I'm more than happy to invest there rather than putting my money in a business that may be losing money for the next 10 years and then might have a slim chance to make me rich over the next 30 years. Berkshire makes $4.7 billion in yearly dividends. On top of that, the company's net income in the last 12 months was $85 billion. This is one of the highest cash earning businesses, just beat by Apple. And on top of all this, Berkshire Hathaway currently has $150 billion in cash on their balance sheet. Imagine how many amazing companies they will be able to buy if we hit a recession. Now, some people have often asked me, what if Warren Buffett retires tomorrow and is no longer going to manage the money? Warren Buffett has elaborately discussed this in previous shareholder meetings of Berkshire Hathaway. Greg Abel and Ajit Jain will be representing the next in command for Berkshire Hathaway, and those two have stayed with the business for more than 30 years each. And I look at it more of a situation where Steve Jobs left Apple and people thought Apple will no longer be a success, but with Tim Cook, Apple has become from an $800 billion company to a $3 trillion company, just showing that if great managers come in line and the right succession happens, big businesses can always be a bigger success. I would also like to add that the next money managers in Berkshire Hathaway after Warren Buffett might take additional risk given the fact that they already have a $150 billion of cash war chest that they can sit on, and that will help them protect their best interest in terms the businesses go through small downturns. Number 4, buybacks. So even after making making so much money, Berkshire Hathaway does not pay any dividends, and people often question this. But dividends are a worse use of shareholders' money if you think of it in a logical manner. When a company issues a dividend, the money is taxed double. First, on the corporate level when the company makes its income, and the second time when it actually gives a dividend, you as a shareholder gets taxed based on your personal income level. Now, instead of making this colossal waste of capital, Berkshire Hathaway simply buys back its own stock. And when a company buys back its own shares, it reduces the total amount of shares outstanding in the market, thus making the existing shares much more valuable compared to the total assets of the business. These share buybacks have consistently increased in the past years, and Warren Buffett is not shy of spending billions and billions on buying his own stock if he thinks that the market is low compared to the intrinsic value. And finally, valuation. As we speak, Berkshire Hathaway has a book value of 1.36, a price to sales ratio of 1.91, and a PE ratio under 9. With a return on equity of 19%, I think that the current market price does not even represent the fair value of the business, Berkshire subsidiary businesses, their assets, their cash on hand 150 billion, their stock portfolio, only from which Apple's holdings are worth 160 billion, in total comprise a much bigger value than the current market price of Berkshire Hathaway. And in my opinion, Berkshire Hathaway is definitely undervalued compared to its future potential. So that summarizes why I think Berkshire Hathaway is the best stock to own in 2022 and going forward. And if you like this video, make sure you subscribe to my YouTube channel for more investing tutorials and follow me on Instagram. See you later.